There are two banks, same logo, same building, same marble floor. One of them is designed to take from you. The other is designed to keep you. You've probably only ever met one of them, and by the end of this video, you'll know exactly which moment your bank decides to switch. Because here's the thing nobody tells you. Your bank account isn't a place you keep money, it's a tier. And I'm going to walk you through every single one of them, from $0 to $100 million, so you can see exactly how the system's treatment of you changes. Not because you become a better person, but because a number changes. Let's start at the bottom. Tier 1. $0. Overdrawn. You're standing at a register, doing math you shouldn't have to do out loud. Your balance was already thin going into today. A forgotten $9 subscription hit 2 days early. Some app you tried once and never canceled. And now you're negative by less than the price of a sandwich. You didn't overspend. You didn't make a bad decision. You made a small, human, forgettable mistake, and the system doesn't know the difference between that and reckless spending. It only knows one thing: your balance crossed zero. So it charges you a fee. At most major banks, that's somewhere between $30 and $35, applied instantly, automatically, with no human being ever looking at your account. No warning, no grace period. Just a rule firing the moment the number goes negative. And it compounds. A second small charge, say $7, lands a couple of hours later. Your balance is already negative, so the bank covers it and charges you a second fee for the privilege. By the time you check your account that night, sitting in a parking lot, a mistake worth single digits has ballooned into a debt worth triple digits. Roughly $77 from a $9 slip. Here's the part that's actually the hardest to sit with. This isn't personal. Nobody at the bank decided to make your week harder. Nobody reviewed your file. A machine processed a transaction, applied a rule, and moved to the next account. At this tier, you are not a customer. You're a liability the system is built to extract from, right up until the moment you cross back into positive territory. Tier 2. Barely positive. You climb out. Not dramatically, not with a spreadsheet or a plan. You just start saying no. No to the coffee runs. No to the subscriptions. No to the small yeses that used to feel harmless. You pick up an extra shift. You move $12 here, $20 there, like you're solving a puzzle with pieces that don't quite fit. Eventually, one ordinary morning, you check the balance and it's positive. Not by much, enough for gas, not much more, but positive. You don't celebrate. You just feel the dread lift a little, which is its own quiet thing. The bank doesn't notice. That's the part nobody warns you about at this tier. Climbing out of the hole doesn't put you into anything. You're just above zero, technically, and technically is exactly where the system leaves you. You still have the same basic checking account, and it still carries a monthly maintenance fee, often $12 to $15. Waived only if you keep a minimum balance most people at this tier simply don't have. So every month, the bank collects a small structural tax for the privilege of holding what little money you've got. And if you want to start building credit, which you should and which everyone tells you to, you're offered a secured card. You hand over $200 of your own money as collateral. The bank holds it, gives you a $200 limit, and charges you somewhere between 26% and 29% annually to borrow money that was already yours. It's not a trap built specifically for you. It's just the product designed for this tier, and it happens to cost the most to the people who can least afford it. Tier 3. Stable. Something shifts, usually somewhere around a year to 18 months in. Nothing dramatic. No letter, no phone call, no moment where the bank sits you down and says, "We see you now." It's quieter than that. You just start noticing the friction is gone. Holds that used to take 3 business days clear overnight. The app stops flashing warnings at you. A credit card offer shows up in the mail. A real one, unsecured, your name printed on it. And you almost throw it away out of habit, because you've been trained to assume good mail is a mistake. It isn't a mistake. What actually happened is your direct deposit became consistent. Same employer, same amount, same day, month after month. You didn't do anything strategic. You just kept showing up to a job that kept paying you, and the system noticed. Predictable income is the single variable that changes everything at this tier. Not because the bank trusts you as a person, but because consistent cash flow moving through their system makes you cheap and low risk to keep around. The maintenance fee disappears from a statement without you asking. Your credit score has been climbing quietly the whole time. Not in leaps, in the kind of small, boring increments you only notice when you look backward. And when you finally go in for something bigger like a used car loan, the rate they quote you might be several points lower than it would have been a year earlier. The same debt, priced completely differently, because the system now reads you as less risky on paper. Tier 4, 6 figures, investable assets. The first time someone at the bank says the word portfolio to you, you're sitting in an actual chair, upholstered, on the other side of a desk, in an office with a door that closes. That's a different experience than the plastic chairs by the teller line, and you notice it. You've crossed into 6 figures, not net worth, investable assets. The 401k you started when you finally got a job that offered one. The index funds you set up after watching enough videos to feel barely confident. The savings you built with the discipline of someone who still remembers exactly what a $77 overdraft felt like. The bank noticed before you did. Growing balances and consistent contributions get flagged internally, and your account gets routed to a different part of the institution. A relationship manager reaches out, not obviously to sell you something, to introduce themselves and ask what you're trying to do with what you've built. Nobody has ever asked you that at a bank before? The fees that quietly drained you for years aren't waived at this tier. They're structurally absent from the accounts offered here. You're handed a credit card you didn't apply for. No preset spending limit. A reward structure that actually returns value. An annual fee that costs more than a year of your old maintenance charges, but pays back multiples of that if you use it right. None of this is a gift. It's a retention strategy. You are now expensive to lose, and the warmth of the experience is calibrated exactly to that fact. Tier 5. 8 figures and up. Private banking. There's a phone number that doesn't exist on the website, that you won't find in the app, that you won't get by calling the main line and pressing 0. It rings once, maybe twice, and a specific human being picks up. Not a representative, a person assigned to your account the way a doctor is assigned to a patient. They already know your name. They already have your financial picture open on a second screen. Private banking isn't wealth management with better branding. It's a different category of service. Wealth management is scaled. One manager handling hundreds of relationships. A private banker manages fewer than 20 accounts. 20. The depth of attention that ratio implies isn't comparable to anything in the earlier tiers. They call you before you know you have a question. A mortgage you merely mentioned in conversation comes back 3 days later with a rate that isn't published anywhere. Paperwork that takes a normal customer 4 to 6 weeks processes in 48 hours. Not because the rules changed, but because internal priority is discretionary. And at this level, discretion bends entirely in your direction. You're offered access to investments before they're available to anyone else. Private equity allocations with minimums normally sitting at $250,000 waived. The person who manages strategy for billions in client assets flies out to ask your opinion, not to advise you, because your decisions move enough capital that your view has institutional relevance. The turn. Here's the part that's almost impossible to hold next to everything you just heard. At this exact moment, in the same building, on the same day, someone else is on hold. 43 minutes. The same 4 bars of hold music cycling on repeat. Waiting to speak to someone about a $35 overdraft fee on a $9 mistake. They'll explain the situation politely. They'll be told the fee has been reviewed and, unfortunately, cannot be waived. They'll hang up and sit with that for a while in the specific silence of someone who just lost an argument with a machine. And in a different part of the same building, someone else isn't waiting for anything. The contrast isn't hidden. It isn't something the institution is ashamed of. It's the architecture. Same brand, same logo. Same marble floor you noticed the first second you walked through the door. And behind it, two completely different experiences of what it means to need something from a bank. One of them costs you, the other one pays you back. The only thing that ever changed, from the first tier to the last, was never your character. It was never how hard you worked or how responsible you were with money. Plenty of responsible people are still stuck negative $77 in a parking lot somewhere tonight. The only variable that moved was a number. If this broke something open for you, subscribe to my YouTube channel and enjoy more financial strategies.